Imagine this, you've finally saved up some money to invest, you open up an investing app and then boom, suddenly you're drowning in fun names like Vanguard FTSE All World UKITS ETF accumulating GBP. But what does any of that even mean? Well, today's video is going to cut through all of the investment jargon that you might not quite understand. By the end, you'll know exactly how to pick the right index fund, how to avoid expensive mistakes, and how a simple monthly habit could one day make you a millionaire. Chapter 1, choosing the right platform. Step 1, you need a platform. Think of this like picking the shop you'll buy your investments from. In the UK, you've got three main types. One, traditional brokers, Hargreaves Lansdown, AJ Bell, Vanguard. They're reliable, been around for years, but sometimes they feel like the Tesco of investing. Lots of choice, slightly higher prices. 2, app-based platforms. Trading 2-on-2, free trade, sleek, simple, usually the cheapest. They're like Aldi or Lidl. You don't always get frills, but you get the essentials for less. 3, robo-investors. Moneybox, Nutmeg, they pick funds for you, but they charge you for the privilege. Honestly, it's like paying Deliveroo to bring you a sandwich you could have made yourself. Now, whichever you choose, make sure of 2 things. They're regulated by the FCA, the Financial Conduct Authority. They're covered by the FSCS, Financial Services Compensation Scheme. That way, your money is protected up to £85,000. Which platform are you currently using? Chapter 2, picking the right account. Once you've picked your platform, the next big question is, what type of account should you use? You usually see 3 options. General Investment Account, GIA, the most basic, easy, flexible, but you'll pay tax on gains above your allowances. Stocks and Shares ISA, my number 1 choice. For beginners, you can put in up to £20,000 per year and all of your growth and dividends are completely tax-free. This is a no-brainer if you're in the UK. SIP, Self-Invested Personal Pension. Brilliant for retirement. You get tax relief up front, but you can't touch the money until your late 50s. Let me use a little example. Imagine 2 investors. Investor A uses a general account. They build up £100,000 over time. When they sell, they will lose thousands to capital gains tax. Investor B does the exact same thing inside a Stocks and Shares ISA. Their £100,000 is all theirs. No tax, no stress. Same investments, totally different outcome. Now, before we carry on, I'm obsessed with helping people to retire early because over the last 20 odd years, I've seen too many people with too many regrets, mainly financial. So hit that subscribe button so we can build wealth together and so I can help more investors, especially beginners. Chapter 3, understanding fees. So time for the least exciting word in finance, fees. But trust me, this is where most beginners quietly lose thousands without even realising it. There are 2 types. 1, platform fees, what the broker charges you to hold your account. 2, fund fees, ongoing charges, OCF, what the fund itself charges every year. Now here's the thing, even small differences in fees add up massively over decades. For example, let's say you invest £500 a month for 30 years. At 7% growth with a 0.07% fee, like Vanguard S&P 500 fund, you end up with 610,000. But with a 1% fee, that drops to 510,000. That's 100,000 gone, straight into someone else's pocket. So the golden rule is simple. Keep your fees as low as possible. You don't need a fancy fund manager in London charging you 1% a year. You just need a cheap, boring index fund, quietly compounding in the background. Now, as always, nothing in this video should be taken as financial advice, and the full disclaimer can be found below in the description. Chapter 4, ETFs versus index funds. Now let's clear up some jargon, some more jargon. You'll hear people say ETF or index fund. What's the difference? Index funds are priced once per day, usually at the end of trading. ETFs, exchange traded funds, trade like a stock, so you can buy or sell them anytime during the day. For long-term investors, honestly, it doesn't really matter. Not that much anyway. They're like 2 different brands of water. Slightly different packaging, the same thing inside. The one thing to look out for, check the fund's replication method. Physical replication equals the fund actually buys shares in the companies. Synthetic replication equals they use swaps and contracts to mimic the index. I don't know about you, but I'd rather my money actually owned Apple, Microsoft and Tesla. not some complex financial contract. So look for the word physical. The devil is in the detail. Would you prefer your fund to actually buy the companies, or don't you mind synthetic as long as it's cheaper? Let me know below. Chapter 5, decoding fund names. Here's where most beginners get lost. The names. Take this mouthful for a little example. The Vanguard FTSE All World UKITS ETF. Accumulation. Let's break it down. And if you need to press pause and take some notes, do it. Vanguard equals the company running the fund. FTSE All World equals it's tracking thousands of companies across the globe. UKITS equals it follows European rules for safety and structure. ETF equals it trades like a stock, as I've said. AC, accumulation, dividends get automatically reinvested. If it said DIST, that's distributing. You'd get dividends paid as cash into your account. Quick analogy. Accumulation is like a snowball rolling down a hill. Every dividend gets packed on, and it grows bigger and faster and equals more wealth at the end of the day and financial freedom. Distributing is like taking a handful of snow out of the snowball every quarter and putting it in your pocket. Both work, but if you're in the wealth building stage of your life, accumulation usually makes more sense. Chapter 6, S&P 500 versus global index funds. So now the big decision. Do you buy a US fund like the S&P 500 or go global? Here's the difference. The S&P 500 is 500 of the biggest US companies. Think Apple, Microsoft, Amazon, Google. Historically, very strong. Fees are usually really low, around 0.07%. Global funds, thousands of companies across the world, including emerging markets like India and Brazil. Fees are higher, like maybe 0.2%, but you're more diversified. Here's a stat that blows people's minds. Apple alone makes up 4% of the entire global index. One company, that's bigger than the entire UK stock market, which is about 4% as well. That shows you just how dominant the US is. In fact, about 65% of a global fund is already US companies. So even if you do go global, you're still heavily invested in the US. That's why a lot of people, like me, hold a mix. S&P 500 for cheap US exposure and a global fund for balance and diversification. What about you? S&P 500 or global? And if you're not quite sure, you can join my free investing community on School. Link can be found below. Chapter 7, how £500 a month becomes 1 million. So let's bring this to life with some real numbers. Say you invest £500 a month into a global index fund inside an ISA. Let's assume an average return of 7% a year. After 30 years, you'll have put in £180,000, but your portfolio worth over £900,000. Now let's say you go bigger, £1,000 a month, same time frame, same return. Suddenly, you're looking at £1.8 million. That's the power of compounding. At first, the growth looks really small. £500 becomes £520, £540, but fast forward a decade and your money is grown by thousands every year. What's your goal number? Are you aiming for 500k, 1 million, or financial freedom sooner? Let me know in the comments. Summary. So, to wrap this video up, 1. Pick a low-cost platform that's FCA regulated. 2. Open a stocks and shares ISA if you can. 3. Choose a simple, diversified index fund. Global or S&P 500 are really good starting points. 4. Keep your fees low and let compounding do the heavy lifting. Investing doesn't have to be complicated. In fact, the best strategies are usually the simplest. If you want a step-by-step tutorial to help you get into investing, build wealth and retire early, see below for my latest playlist on this very channel.